welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, March 1st, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Currently, we've got futures down just a bit. Dow futures down a little more than 200, which is about 2/3 of 1%. S&P 500 down about 30. Which is about the same percentage, and NASDAQ futures down about 100, also around the same percentage. So we're looking around 2/3, 1% to maybe 7/10 of 1%, right in that range. We'll see where we open. Obviously, things change very quickly right now. Volatility index has been elevated for quite a while. So we literally should be expecting just about anything. Certainly seems to be a little bit of an escalation in the Russian-Ukraine conflict. There are satellite images of the Russian convoy approaching the capital of Ukraine. And as a result, I think some of the fears are growing that this could escalate, the war could escalate. We've got crude oil futures now, or crude oil up over $100 a barrel. So it is up $5 or a little more than 5% overnight. And so crude oil prices shooting higher. We got the 10-year Treasury yield down another 9 basis points to 1.75%. So clearly the bond market, at least, you can look at this one of a couple of ways, I guess. You can say, well, based on this conflict, this is like the final straw, maybe that's going to send us into a possible recession. That could be why everybody's jumping into bonds, sending yields lower, or it could just be safety. There's a conflict, the volatility is high. Let's make sure we're safe with our money. The problem I have with that last part is if you're really worried about inflation, 6%, 7% core CPI right now, do you really want to own a bond yielding 1.75%? Because it seems like you're losing about 5% under those conditions. But anyhow, that's what we've got right now. So that's what we're dealing with. Like I said, futures down, market's a little nervous. But that's the environment that we're in right now as we remain in this first quarter of 2022. It is March, though. We got a new month. I believe this could be a rough month. But we'll see. I mean, the growth stock should benefit from the yields dropping like this. So that's going to be the wild card. I noticed most of the growth stocks were down again this morning. But you would think with yields dropping, the threat of higher interest rates is what's been been causing a big sell-off in that area. So anyhow, we're going to get into all of that stuff. I could talk about it forever, but I'll go through the agenda with you here. For today. So we'll start off with the daily market recap, get into talking technically, then take a look at sentiment, earnings spotlight, and the 3 you must see. Before we get into any of that, though, I'll take you over to earningsbeats.com. If you are new to the show, welcome. Love to have you come over and join us over at earningsbeats.com. If you go to our website and then you scroll down, we do have a free newsletter, and you can see name, email address. Click that subscribe button. We'll get you set up. You won't be spammed. We're not going to sell your email address. We don't do that. We protect your privacy. But it is a completely free newsletter. No credit card required. You can unsubscribe at any time. I think it's very educational. Also, we'll probably provide you some potential trading candidates from time to time if you so choose. Of course, those risks are yours. We're just showing certain charts and developments, market developments from an educational perspective, but you're welcome to do with it what you'd like. But again, go over to earningsbeats.com, scroll down, and make sure you sign up for our newsletter. All right. Daily market recap. Well, I mean, I thought the market held up pretty well yesterday. We did have bifurcated action. And by that, I mean, you look at the major indices, some were up, some were down. Dow Jones Industrial Average down 166 points, the S&P down 11. NASDAQ, though, up 57. Mid caps basically flat, small caps up 5. So on a percentage basis, both the NASDAQ and the small caps were up about 0.4%, while the others struggled a little bit more. So the Dow, the worst of the indices I just covered. Dow down about 0.5%. One thing I do want to point out here, which is very interesting and certainly is grabbing my attention, is that as we keep moving lower in this, what I still believe is a cyclical bear market, notice the AD line breaking to new highs on the Dow and the S&P 500, and not far from doing so on the NASDAQ. That tells me that this is probably nothing more than a short-term move to the downside. It's very unusual to see this kind of a drop. I mean, we were at 37,000 on the Dow. Now we're down under 34. We were under 33. The S&P 500, which was above 4,800, went all the way down to 4,100. And through all of this, we're looking at the AD lines, accumulation distribution, actually moving up to a new high. And it gets back to the point I made recently, where when we broke down below the neckline, the volume was kind of light on that move, but the move back up through the neckline, what should have been resistance, was actually pretty heavy. And that all plays into that AD line. So this is something to just keep an eye on, because this is clearly, in my mind, a check mark in the bulls column. And, when I've talked about the cyclical bear market, I continue to talk about the secular bull market, that I believe once this is over, we're going higher. And this kind of plays right into that thinking. So anyway, just wanted to point it out, something to at least keep an eye on. As far as sectors go, Monday, energy was the leader, up 2.5%, but that was about where most of the strength ended. I didn't show it here, but industrials had a pretty decent day. But looking at the losers, real estate down 1.7%, financials 1.5%, consumer staples 1.3%, materials 1.1%. The good news is that as you look across here, no technology, no consumer discretionary. So those groups at least were spared a little bit on a relative basis. We'll see today with futures down, how all that plays out. 10-year Treasury yield. So this morning, we've got a couple of reports out. We got the February PMI manufacturing due out. The estimate there, 57.5. The February ISM manufacturing estimate, 58.0. Had an interesting email from a member not too long ago asking about these two reports. And I think they'd looked it up somewhere on, I don't remember, Investopedia maybe. I don't remember where it was. But they said these two reports are identical, that one is the same as the other. But I've been getting these separate readings. So I thought I'd just take a second because I did a little bit of research. And the February ISM manufacturing is actually a subgroup of the February PMI manufacturing. So I think there are like 11 different things that the February PMI manufacturing looks at. And the ISM manufacturing is a subgroup of about 5, I think, of those 11 components. But anyway, member was asking because they like to track, some of these economic reports and what they mean and so forth. Anyway, I just wanted to point out that they are different, but only slightly different. The same information is used for the ISM manufacturing that also is used for the PMI manufacturing. It's just a subgroup. Also, later this morning, January construction spending will be out. That's a report that really is in the rearview mirror. It's January. Here we are in March. We're talking about January construction spending. Anyway, it was, or it is expected to be down 0.2%. December was up 0.2%. The 10-year Treasury yield, though, I was looking for 1.86, 1.87 to hold as support. We closed yesterday at 1.84, so we lost that yield support on the close. And then this morning, we're looking at the yields down right now, another 8 basis points to 1.75, 1.76. So this is, kind of crazy because you're trying to figure out, at least I'm trying to figure out, with the inflation out there, with what the Fed's expecting to do, a possible recession on the horizon. We got this conflict going on. Why are folks moving into treasuries and sending the yield down so much here in the last couple of days? I mean, we were at 2% on Friday. Now we're at 1.75% on Tuesday morning. That's a huge drop in the 10-year Treasury yield. Tons of money going into treasuries. is it, are investors believing that the Fed's going to back off of their more hawkish stance of late and become more dovish again? I've said I believe that's what's going to happen later in the year, but is the market starting to price that in now? It's going to be a very interesting thing to watch. It's something I'll be keeping a very close eye on here over the balance of this week and really throughout this month. If that yield keeps dropping, I don't know. I mean, I'm not sure how much lower we go. That yield should really begin to help some of these growth stocks, unless the recession is expected to be bad. And then, of course, everyone's earnings go down significantly. So it's going to be a very interesting month, to say the least. Anyway, just I'm kind of talking out loud, thinking through some of the thoughts that I've been going through and that I've been thinking about of late. All right, let's move on to talking technically. So here's a chart of the S&P 500. There's your breakdown of that neckline, 4,300. There was your volume, which you don't even see a rise in volume. That was unusual. And then last Thursday, with the big gap down, the volume came pouring in, but there was a recovery with that volume. And we got back up near the 4,300 level, and now we've traded back up above it. I've seen many times neckline breakdowns, and then you go back up through the neckline and fail at the 20-day, and then back down you go. And that's exactly what I would be expecting if the volume here had been weaker, or if the volume had been stronger on this breakdown. So when the market was weak, broke the neckline, I would like to have seen more volume. That would have given me even more reason to have been bearish. With this volume light, that kind of, it's not that this whole overall move to the downside isn't bearish. It's just that, I'm looking for that confirming volume so that I can establish my measurement, which would be down to 3,800. When I see a light volume breakdown like that in recovery, it just tells me maybe 3,800, maybe we don't get there. The measurement saying, I don't know that we can count on the measurement at this point. So maybe we don't go back down all the way to 3,800. I'm torn because, again, I'm bullish long-term. So I don't want to get caught up in this short-term bearishness and say, hey, we're going lower no matter what. That's kind of a bias that you don't want to get into, where you've predetermined where you think the market has to go. And then no matter what the market does, you try to figure out a way why it's still going to play out the way you thought originally. You know what I mean? And that can be a dangerous thing. So I'm kind of watching this, and I just want to, be objective about this. I still believe we go lower, but the way this has transpired, the way that AD line now is broken out, the fact that we're getting yields back down as much as we are, things are changing. And so we have to be ready to reevaluate. And I guess that's where I am right now, looking at all this. One thing I did want to mention, though, because I was over at CNBC, I get a lot of pre-market stuff over at cnbc.com, but I can't help but notice some of the headlines from time to time. And there was a headline that came in this morning and said, Goldman says stock pickers are buying the dip in growth stocks. That's what they say. Well, here's your growth versus value ratios. Large cap right here, mid cap and small cap. Now, I'm not sure which dip. Are they talking about this last dip and the fact that the market's gone up the last couple of days? Yeah, I can kind of agree with it, but I don't see any kind of major breakouts here in growth stocks versus value. I still see downtrends. Now, the mid caps and the small caps have kind of gone sideways a little bit, while the growth stocks have been continuing to move lower on a relative basis. And I think some of that has to do with that surge that we saw in the treasury yields that I was talking about, where we right here, this whole surge, I think, was really driving growth stocks lower. But now we got this going back the other way. And that is why I think we need to keep watching these growth stocks. We could see mid caps and small cap growth break out to about 6-7 week high. That would be an interesting development. This is a group. These are a couple of different asset classes. Excuse me. Grab some water. I can tell springtime's approaching, that's for sure. Anyway, if we get this breakout in the growth the mid cap growth versus mid cap value, and also same thing for small cap growth versus small cap value. That would start to paint a little bit more of a bullish picture. We'd have to at least recognize the possibility that growth stocks are back in favor. I mean, when we were moving lower back at the end of remember the first surge in inflation, February to May of 2021, and we all went down to these new lows, then we bounced, then we looked like we were rolling back over again, and then we set new highs, breaking out of these above these prior highs. Well, if we start to do that here, we have to take note of it. We can't just ignore it. So that is why I'm watching this. I'm not ready to say, hey, jump into growth. But, if the group starts to move on a relative basis and gets to a 6-7 week high relative to value, then I think, we have to at least be considering the possibility that maybe we are going to have another run in these growth stocks. So one more thing to think about. All right, let's talk about sentiment for a minute. Here is a chart of the S&P 500 that goes back 5 years. And the reason I went back 5 years on this chart was I wanted to get into this chart, the current, what I believe, cyclical bear market. Many areas, by the way, have already hit that 20% threshold. I mean, if you look at some of these growth stocks, they're down, their indices are down more than 20%. So, we can talk S&P 500 and say, well, it never got to 20%. If it doesn't get there, then it's not a bear market. If you look at a lot of the component stocks, I think you could argue that a lot of them are in a bear market. The key has been that we haven't yet seen enough weakness in those large cap components, the Apples and the Microsofts, to really drag the market down into that 20% category. Will it happen? I don't know. I still believe it's going to. I think with the yields dropping, watching the AD lines, I would say the percentage might not be as high as what I once thought it was, but I still would say it's greater than 50-50 that we go lower. But I'm at least coming around, a little bit to the point, maybe, with what's the changes that are taking place here now, all of a sudden the Fed maybe not being as hawkish, because I really believe that is what was driving the growth stocks, the large cap growth. That's why we were finally starting to see that those groups roll over. I believe the Fed was going to make the mistake of raising rates multiple times. And now with what the 10-year Treasury yield's doing, maybe it's signaling to the Fed not to raise rates. And that could be a little bit of a game changer here. And that's why we've got to be open to the possibility of a change taking place in the market. Anyway, this move right here looks somewhat similar to what we saw in the cyclical bear market back in the fourth quarter of 2018, the trade war cyclical bear market that we endured. And you can see that as we were moving lower and bouncing, look at the VIX, the volatility index I put on the chart here. We would rise up and then we'd pull back when the market would rally, and then we'd rise back up again and set new highs. And you can see that final low was a peak that we got all the way up into the upper 30s, which is close to where we are right now, or where we were at the recent lows. So you might say, well, maybe that's it because we got to the upper 30s, and it could be. But I do want to just keep in mind that when we started that bear market, the VIX was down at about 12. It was much lower. And so going from 12 to 38 was pretty significant. And it took that one final big swoosh. All of a sudden, if we had a channel going, we broke out of it to the downside when we got this massive last move to the downs. And by the way, that's when the Fed screwed up. If you go back and you study, I actually wrote a blog article right around that time. The Fed, Jay Powell, came out and said they were going to raise twice in 2019. And based on everything I was looking at, I was like, there's no way they're raising rates. This is no way. And I wrote that very thing. They were not going to lower rates. Or excuse me, they were not going to raise rates. And in July, they actually ended up raising, lowering. I'm getting it all backwards. So I said they were not going to raise, and then they ended up lowering. Their next move was to lower in July of 2019. So very similar, but this was when Jay Powell was saying, hey, we're going to raise rates twice in 2019. And you can see how the market reacted to that. Growth stocks got hammered. And so that's kind of what I'm thinking is unfolding here is that the Fed is going to make another mistake, start raising. Growth stocks are going to get hit, those large cap growth stocks especially. And that is what's going to cause one more big move like this. And maybe end of March, maybe April, we come down and we set a low. We break down below this channel. The fear shoots up into the 40s. And by the way, when we started the fear here, the fear was up at about 17. So it was much higher than the 12 level here. It was more complacent back in October 2018 than it was starting this particular cyclical bear market. So that's kind of what I'm looking for, is the VIX to spike up, really have one more panicked low, which would come maybe with the next CPI report, maybe with the Fed and what they talk about. It may still, I don't know, things are changing, but we've still got those things to contend with in March. So that's going to make this month a very crazy month for sure. All right. I got one more sentiment chart I want to show you. Let's see if we can get to this. So this is a chart that I've been showing. It's the 253-day moving average of the equity only put call ratio. And you can see, I pointed this out probably 2 months ago when we were just starting to turn up and take out this prior high. And there's a resetting of what's going on in the market right now, in my opinion. And that is that we're getting a little bit more fearful. And I think that's a really good thing for the market. The market needed to be fearful. The market, it was like, I don't care what's going on. We're just going to keep buying calls. That's the way the options market has been treating. And look at the 1 year moving average of the equity only put call ratio way down here, way below these prior lows. So it was just kind of an unsustainable bullishness that the only way you get this number back up is by scaring the heck out of folks. And with that VIX rising the last 2 times up in the upper 30s, seeing these big swooshes to the downside in the market, growth stocks getting hit so hard, that is now starting to change the sentiment. And folks are growing more bearish. And if we keep going down and we do get to 3,800 or maybe even 3,500, we're probably going to see this reset somewhere back up in the mid 50s to around 6.60, 0.55 to 0.60, somewhere in here is where I'm looking for. And there's no one level. It's not like we get to this level, I'll start buying the market. It's just, we just need to reset. We just need to see more bearishness come in. I want to see this line go up further than where it is right now. And that will only come from the market getting weaker. I mean, we've seen over the last 2 days, I actually wrote my daily market report to members yesterday, and I showed the equity only put call table from over at the CBOE.com. Or actually, I think I showed them my Excel spreadsheet, which was tracking the information I get from CBOE.com. And you can already see with the market up these last couple of days, you can already see the shift going back toward more bullishness in options. And I just think the market needs to reset itself. It needs to be a little bit more bearish. So again, I don't know how all this is going to play out, but I do believe the odds are greater that we still have a move to the downside. But I'm not, it's not like it's set in stone. It's not a guarantee by any stretch. And so I'm open to the possibility that we go higher. I just don't believe at this point that that's the likelihood. I still think that the odds favor more downside action for some of the reasons I've talked about today. All right, let's move on to earnings spotlight. So last night after the bell, Workday reported, and Workday having a really nice response this morning. Workday was up about a little more than 7%. They beat 78 cents versus 71. And looking at the chart, this was one I was watching last night or yesterday afternoon before the close, because we were getting up. You can see we've really struggled to get through the 20-day moving average. And today, at least earlier when I was looking, this was set to open at 245, which would be up close to the 50-day moving average. So this is going to be a test. I would guess that it's going to gap up and then print a black candle. But with rates coming down, this is a growth stock, and this is where things are going to be getting tricky as the yield keeps falling. You know, do you want to short a growth stock when yields are going down? You know, the last 3 days, we can see a big reversal with the yields coming down. Now, another big drop in the yield today. Are we going to see a gap up and a big breakout? I don't know. This is going to be a very interesting day for Workday. Let's see, LCID, this is Lucid Group. So this is in the auto space, another one that's been downtrending for a while. Well, it's down another 13% this morning. They actually missed. They were expected to lose 26 cents. They lost 37 cents. So they missed. So this one did come up and looks like it made the breakout just barely above the 20-day. And now that was the head fake. And we're going to have another big move to the downside, at least at the open, down 13%. Probably one of the reports I've been looking forward to was Zoom. And Zoom, you can see also starting to see a little bit of strength recently, but it is down 3% this morning at last check. They beat $1.29 versus $1.07. So that was good. They beat on their revenues as well, but they lowered guidance going forward. And so that's the problem with a growth stock is anytime you lower guidance, you're lowering your valuation for sure, because now you're earning your growth rates into the future have to be lowered. Unless you can say that this is a one-off and you can prove to Wall Street that, hey, this is just for this quarter. Next quarter, we'll be right back to where we were before or what we were expecting before. Unless you can do that, these types of lowering of guidance of growth stock reprice. Now, the question is, has it already been beaten down enough? Well, management thinks so because they unveiled a $1 billion repurchase plan today or yesterday after the market closed. So they're in a position to start buying their own stock now. So I guess management's had enough. They think it's gone down enough. We're going to find out. We're going to find out. I don't know if it's been enough or not, but we are going to find out. One company that reported this morning that looks really good is Target. Target reported this morning and is up more than 11%. This is a stock's been beaten down pretty good, but you're talking 11%. That's going to be up over $20. Going to be back over the 50-day moving average. Definitely a stock to consider. But the question is, again, after the gap up, do we see a hollow candle, a move to the upside, or do we get the selling from the market makers? I don't know. We'll see. All right, last thing, 3 you must see. Let's go through these real quick. First, Upstart. Remember, had the big move up after earnings a couple of weeks ago? Went all the way back down, filled the gap, went a little bit below, and now it's actually breaking back out again. That's how volatile stocks can be around their earnings reports. Just wanted to point it out. Gap fill, and now a potential breakout. Enphase, look at this, gap up with earnings. And we went all the way down to the prior low from 180 down to 120 in a couple of weeks. And now we're back up near 180 again. That's why I watch earnings, get some crazy moves around the earnings season. Qualcomm, last 2 earnings. Here was one with the gap up and the move higher subsequently. Here, we gapped up, failed, and then we had to move lower. So Qualcomm's just sitting in this trading range between about 155 and 190. All right, that's it for me. Thanks so much for tuning in. If you like our videos, just click on the like below. Really appreciate it. And subscribe to the channel here at StockCharts. I'm sure they'd appreciate that. Listen, have a great day. I'll be back over at Earnings Beats on Wednesday morning for your next Trading Places Live. Take care. Be careful out there, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.